Welcome to office hours, everyone. Come on in, grab a seat. I'm literally so thrilled you're here today because, well, we're going to demystify something that frankly confuses almost every homeowner at some point: mortgage math. Consider this explainer your absolute crash course in Finance 101. We're going to pop the hood on your home loan, translate all those incredibly complex mathematical formulas into just plain, everyday English, and give you the exact tools you need to evaluate what's probably one of the biggest financial decisions you'll ever make: refinancing. So let's jump right in. Okay, let's dive into this with a quick question. Imagine you took out a standard 30-year mortgage, right? And you've been dutifully making your payments every single month for 5 straight years. If you wanted to just write a check and pay off the entire loan today, how much do you actually owe? I mean, is it simply the original loan amount minus the sum of your payments? Well, not quite. To really answer this, we've got to bridge everyday homeownership with some actual financial mathematics. So here's our syllabus for today's explainer. First, welcome to Finance 101. Second, deriving outstanding loan balances. Third, retrospective versus prospective methods. Fourth, calculating the break-even point. Fifth, advanced cash-out refinancing. And finally, number 6, evaluating the refinancing decision. All right, Section 1, welcome to Finance 101, defining the core concept: amortization. You hear the word all the time, but think of it as the actual engine of your mortgage. It's essentially the method of repaying a loan where your level, periodic payments systematically chip away at the outstanding principal balance. Now, obviously, because lenders charge interest, they're not doing this for free. The total amount of money you end up paying over 30 years is going to far exceed the original amount you borrowed. That difference, that's the finance charge. But amortization guarantees that with literally every single payment you make, the actual principal amount you owe is methodically and mathematically eliminated. Moving on to Section 2, deriving outstanding loan balances. And this brilliantly illustrates the inductive relation formula. Now, in academic terms, you'll see this written as BK equals BK minus 1 times 1 plus I minus CK. Sounds like a mouthful, right? But let's translate that heavy algebra into plain, practical English. If you want to know your brand new loan balance after you make a payment, it's really just 3 simple steps. First, you take your previous outstanding balance. Second, add the interest that accrued during that specific month. And third, just subtract the total payment you just made. Whatever's left over, that's your new principal balance. So basically, your new balance is simply your old balance plus interest minus your payment. Easy, right? Now, when we start talking about refinancing, okay, the algebra definitely gets a little heavier. This closed form equation calculates the present value of all your after-tax monthly payments on an existing loan. I know, it looks incredibly intimidating, but honestly, it's just calculating the sum of the present value of your payments by considering your constantly changing loan balance, your specific interest rate, the opportunity cost of your capital, and even tax subsidies over time. Think of it as the absolute mathematical bedrock for knowing exactly what your current loan is costing you in today's dollars. Which brings us to Section 3, retrospective versus prospective methods. In financial mathematics, we basically have 2 distinct lenses we can look through to figure out what you owe. First, the retrospective method. This one is entirely backward-looking. It calculates your loan balance by taking the accumulated value of the original loan and subtracting the accumulated value of all the installments you've actually paid up to this point. Conversely, we have the prospective method, which is totally forward-looking. This one calculates your balance purely as the present value of all the future payments you still have left to make. And the truly amazing part, the algebraic derivation of the retrospective formula mathematically aligns perfectly with the prospective formula. It's kind of beautiful. Now, what's really interesting about this is how these 2 methods play out in the real world. Let's look at a concrete example. Say Roger buys a car with a $25,000 loan, an 8.5% interest rate spread out over 3 years. And let's say we want to know his exact balance after month 12. Well, if we use the retrospective method, looking at his past payments, the math spits out exactly $17,361.71. But if we flip it and use the prospective method, discounting his remaining 24 future payments back to the present, the math yields, drumroll please, exactly $17,361.71. 2 completely different mathematical paths arriving at the exact same penny. That, my friends, is the magic of amortization. All right, let's hit Section 4, calculating the break-even point. So when you actually want to refinance your home, major institutions like Chase Bank, for example, they take all of those super complex present value amortization equations we just talked about, and they distill them down into a surprisingly simple division problem for us consumers. to compute your own break-even point, which is the exact moment when a new loan actually starts saving you cold hard cash, you literally just divide your total closing costs by your monthly savings. That's it. Let's look at exactly how that plays out. Say you pay $5,000 in closing costs to secure a lower interest rate, and that lower rate saves you $200 a month on your payment. Okay, 5,000 divided by 200 equals 25. So it's going to take exactly 25 months before that refinance provides a net financial benefit. For the first 2 years, you're basically just paying off the fee you paid to get the new loan in the first place. Month 26 is when you actually start winning.
Okay, moving right along to Section 5, Advanced, Cash Out Refinancing.
Now, a cash-out refinance is a bit of a different beast. It allows you to borrow against the equity you've built up in your home, converting it into cash. But mathematically speaking, this alters absolutely everything. Let's say you turn a $200,000 mortgage into a $250,000 mortgage just to pull some cash out for renovations. Because your overall loan balance is now significantly higher, your monthly payments might actually go up, even if your new interest rate is technically lower than your old one. And because your monthly savings might totally disappear or even turn negative, your break-even timeline alters drastically. It becomes a much more complex and potentially expensive proposition to analyze. This brings us to the grand finale, Section 6, Evaluating the Refinancing Decision. So the crucial point here is how all these different variables actually interact. By plugging our variables into those present value formulas from earlier, say a $200,000 loan, a new rate of 3.5%, accounting for taxes and opportunity cost, we can calculate the precise financial benefit. In this specific scenario, the savings amount to roughly $18,000. Subtract a $3,000 fee, and your net financial benefit is a positive $15,190.40. And because that number is greater than 0, the math says unequivocally, yes, for sure, you should refinance. Let's try to make this decision a bit more binary. In our first scenario, with really favorable rates, the present value of the savings easily covers the fee, netting you that awesome $15,000 benefit. But look at the second scenario. Imagine rates have only dropped slightly, right? Giving you a present value savings of just $2,000. Well, if your bank is still charging you a $3,000 refinancing fee, your financial benefit is actually negative $1,000. Actually, let me be clear, scratch that. Refinancing here isn't just pointless, it actively destroys your wealth because those closing costs completely wipe out the minor interest rate savings. And when you're doing this math, it is absolutely vital to perform what we call a sensitivity analysis. Our academic sources highlight that the new interest rate is literally the single most sensitive variable in this entire mathematical framework. Think about it. Even a tiny 5% shift in the new monthly interest rate, which is just fractions of a percent in the annual rate, can alter your long-term financial benefit by thousands of dollars. It's exactly why borrowers haggle over basis points. In the long run, those teeny tiny percentages equal massive amounts of cash. But keep this in mind. The math only works out if you actually let the amortization schedule do its job. There are several very real reasons you might never reach that break-even point. Number 1, you move. If you sell the home in year 2, but your break-even wasn't until year 3, you just lost money. Number 2, rolling excessively high closing costs into the loan amount itself. That just means you're paying interest on your fees, which is never great. And number 3, extending the term. If you had 20 years left, but you decide to refinance into a fresh 30-year loan, sure, your monthly payment will drop today, but your total lifetime interest paid will absolutely skyrocket. As we wrap up our office hours today, I really want to leave you with a slightly more advanced concept to ponder: the mathematical option value of waiting. You see, when you hold a mortgage at a high rate, you actually hold a highly valuable financial option, the right to prepay and refinance whenever you want. But if you use that option today just to lock in a modestly lower rate, you're giving up the ability to capitalize if rates absolutely plummet next year. So before you rush out and sign the paperwork, you really have to ask yourself, mathematically speaking, is the rate gap wide enough today to justify giving up the option value of waiting for tomorrow? Think about that before your next trip to the bank. Thanks for joining me on this explainer, everybody. Class dismissed.